Bankrupt. How a $31 billion repo spike ended the silver rally is not merely a headline about a failed commodity trade or a sudden downturn in precious metals, but a deep, uncomfortable lesson in how modern money, leverage, liquidity, and systemic fragility truly operate beneath the surface of the global financial system. Because when the U.S. repo market, an obscure yet critical corner of the banking system that most retail investors never think about, experienced a sudden $31 billion spike in demand for overnight cash, it sent a silent alarm through Wall Street, signaling that trust between financial institutions was weakening, collateral was becoming harder to finance, and short-term funding was no longer freely flowing. And in a system built almost entirely on leverage, maturity transformation, and continuous access to cheap liquidity, that single signal mattered more than inflation data, more than earnings reports, more than bullish forecasts, and more than any long-term thesis about silver as hard money. The repo market, which allows banks, hedge funds, dealers, and large financial institutions to borrow cash overnight using U.S. treasuries and other high-quality assets as collateral, is the plumbing of the monetary system. And when that plumbing clogs, everything upstream begins to fail because liquidity, not value, becomes the dominant force, forcing institutions to prioritize survival over strategy, balance sheet preservation over conviction, and immediate cash over long-term positioning. And this is where silver, despite its historical role as money, its industrial importance in solar panels, electronics, defense systems, and electric vehicles, and its reputation as an inflation hedge and store of value, becomes uniquely vulnerable, since silver trades inside a highly leveraged financial ecosystem dominated by futures, contracts, margin accounts, derivatives, and short-term funding structures that depend on stable repo markets and predictable financing costs, meaning that when repo rates spike and cash becomes scarce, silver is not evaluated on fundamentals, but on how quickly it can be sold to raise liquidity. As funding stress spreads, margin requirements rise, risk limits tighten, credit lines are reduced, and institutions are forced into indiscriminate selling, dumping assets. Not because they believe those assets are overvalued, but because they must meet margin calls, satisfy counterparties, and roll over short-term debt. And in these moments, silver often becomes a source of cash rather than a beneficiary of fear, which is why so many investors are confused when silver falls during periods of financial stress, even as inflation fears rise, and confidence in fiat currency erodes. Because the paradox of modern markets is that hard assets can be bullish in the long run while collapsing in the short run due to liquidity mechanics that overpower narrative logic. The $31 billion repo spike was not an isolated incident, but a symptom of deeper structural issues that have been building for decades, including excessive global debt, over-financialization, reliance on short-term funding, and a monetary system that depends on continuous intervention by central banks like the Federal Reserve to maintain stability. And while the Fed can inject reserves, adjust interest rates, and expand repo facilities, it cannot instantly restore trust, repair balance sheets, or reverse the psychological shift that occurs when institutions sense systemic risk, because monetary policy works with lags and confidence can disappear overnight. As liquidity tightened, the US dollar strengthened, not because the economy was suddenly healthy, but because global borrowers desperately needed dollars to service debt, post collateral, and settle obligations, creating a classic dollar shortage that historically crushes commodities and emerging markets alike. And silver, priced globally in dollars, suffered mechanically as the dollar rose, and financial conditions tightened, reinforcing the cycle of forced selling. This is why understanding money, finance, and financial history is essential for real financial literacy, because markets do not move solely on fundamentals, narratives, or long-term value, but on the availability of liquidity, the structure of leverage, and the hidden plumbing of the banking system. Lessons that repeat across economic history from the Great Depression to the 2008 global financial crisis to the March 2020 liquidity shock, where silver and other commodities initially collapsed alongside equities before later recovering once central banks stabilized funding markets. The repo spike that ended the silver rally did not invalidate silver's role as a tangible asset in a world of fiat currency debasement, persistent inflation risk, energy transition demand, and declining trust in monetary authorities, nor did it signal the end of precious metals as a hedge against long-term systemic decay. But it did expose how fragile modern portfolios are when they rely on leverage without understanding liquidity risk, how diversification fails when assets are correlated through funding stress, and how hedging strategies break down when everything is forced to compete for the same scarce resource: cash. In this sense, the word bankrupt does not only describe institutions that fail legally, but strategies, assumptions, and mental models that collapse when confronted with real-world market mechanics, reminding investors that silver is not a hedge against margin calls, that hard assets do not rise simply because inflation exists, and that financial independence requires more than owning the right assets. It requires understanding how money flows, how banks fund themselves, how repo markets transmit stress, how central banks respond under pressure, and how quickly market psychology can shift from greed to fear when liquidity disappears. Ultimately, the $31 billion repo spike was a warning shot, a glimpse into the systemic risk embedded within a highly leveraged global economy, where the appearance of stability depends on constant liquidity support, and where rallies can be erased not by bad news, but by invisible funding stress, leaving behind a powerful lesson for anyone serious about investing, financial education, and long-term wealth preservation. In the modern financial system, narratives inspire confidence, fundamentals justify belief, but liquidity decides everything first. And until investors understand that truth, events like this will continue to feel shocking, confusing, and unfair, even though the system is behaving exactly as it was designed to behave. If this video helped you understand what's really happening in the financial system, like the video and subscribe to the channel.